be careful of recency bias. After you get a period of inflation, which we've just had, some people get stuck in that mode. We're going to get more of it. Typically, that's when you lead to deflation. I check every day to see signs of overboughtness. Some markets, the signs that you might have a trigger and hit some sell stops, and it's not showing up in gold. In fact, it's the opposite. Silver, on a 1 year basis, is up about the same as gold, at 40%. That's actually very poor performance for silver. Copper, the number one commodity that I'm really worried about, has to go up, and it's put in signals this year very similar to what crude oil did in 2008.
Okay, ladies and gentlemen, so today we have Mike McGlone, who is a senior strategist at Bloomberg, and today we will discuss the US economy. We will talk about the commodity sector, precious metals, and many other very interesting topics. So Mike, thank you so much for being here.
It's an honor to be on, Vladyslav.
Thank you very much, sir. So we have so much happening in the US right now. What are your macro outlook on the US economy, and what would be some of the things that you are particularly paying attention to right now?
Well, one of the key things you learn as a commodity strategist is I like to focus on that quote by Benjamin Disraeli: what we generally anticipate that seldom occurs. So I have to be somewhat of a contrarian to be relevant. So to me, the big risk is what people started looking for 2 years ago. The big risk is the U.S. economy has that way overdue recession. Now, there's plenty of signs of that. We're going to get retail sales today. We're recording this on September 16th. So we have a little time. Then we have the Fed coming up. Fed's easing, obviously, because there's signs of the economy slowing down. But overall, I think that's the key risk. And the bottom line for me, one of the major indicators I've been watching is obviously gold. When markets go down versus gold, or obviously when gold outperforms everything else, it's typically not a good sign. It's usually inflation or deflation. In this case, I think the risk is that U.S. follows the deflation that's trickling down from China. So one good example is that U.S. 10-year note, as we speak, is right around $4.04%. In China, that 10-year note yield is 1.79%. It's very similar to what happened in Japan a couple decades ago, like 30 years ago, when Japan entered a deflationary spiral. It's happening in China now. And it's a question of how much the U.S. can, avoid that normal deflationary force that typically happens after a lot of inflation. The notable thing I think is happening, obviously, is we have a major disruptive force now with Trump's tariffs and his policies. And the bottom line, I'll end with this, and we can tilt on from there. Is there's one market that absolutely loves President Trump, and that's gold. And every time this way I can say is every time Trump speaks, I think the gold market smiles.
Yes, that's a very good point, sir. And with this two forces, deflation and inflation, so of course we have the stock market valuations, and I would love to get to that as well. And we have the debt levels. On the other side, we have governments who are willing to do absolutely everything to avoid deflation with the money printing. So would you expect they just to print away?
So I appreciate you mentioning that. First, the two key points I take away from that is stock market valuation. That's the number one thing that matters. When we get to over 2 times GDP right now, the U.S.'s stock market is about 2.3 times GDP. That's all that matters. There's only 2 times in history this happened, and that was 1989 Japan and 1929 U.S. Only really significant relative examples. Some people say China got close like 20 years ago, but my measures on the terminal don't show that on the Bloomberg terminal. So that's a key thing to remember. That's all that matters now, is when that starts to reverse. And right now it's not. It's a wonderful thing. It just keeps going up, nothing but up when the Fed's easing. And that's fine. The wealth effect is the greatest in our lifetimes, and certainly going back about 100 years. And that's the number one factor. The other key thing, I think, is what's happening in China. You're seeing, you mentioned money printing. Well, in the US, obviously the problem is we're still running 6 to 7% deficits, and that's pumping up everything. It's helping keep the stock market elevated. It's helping keep bond yields elevated and helping keep inflation elevated. But let's look at the facts, what's happening in China. The latest PPI numbers running about minus 3%. I mentioned the 10-year note yields at 1.79%. That's why I think the U.S. is going. That's despite deficit to GDP running, 300% by some measures. Goldman Sachs put out a measure like that. And money supply in China running more than double the U.S. Some measures say triple, so I'm going to use I'll take double, about $45 trillion. So massive pumping of money pumping to help avoid the normal deflationary cycles that happen in an emerging market that just grew too fast. So that's current trajectory. So where's it go? And that to me is why I look at the whole world market is the things I'm seeing from gold going up a lot and crude oil going down a lot, and copper kind of stuck in between those. Is the market, the whole world stuck between that significant deflationary, normal deflationary force out of China. It's probably just getting started. I think it's early days, and the significant risk asset inflation in the U.S. I think the biggest tilt is going to be when we see a little bit of diversion, a little bit of reversion in U.S. risk assets. And the number one leading indicator for probably all that is probably cryptocurrencies and Bitcoin. And so I'm quite still bullish gold and just very much, I would say, careful and very worried about all our other risk assets.
Hmm. And what would that mean for the US dollar, Mike?
Yeah, so that's a unique part of it. Obviously, right now we have a president who wants to rebalance trade, according to him, which typically it's kind of hard to, it's an oxymoron to say to rebalance trade and have a stronger dollar. So basically need a weaker dollar. And that's showing up. Dollars by some measures versus euro down 10% or so this year. The key thing is remember what drove the dollar the last since 2009. Since 2008, that's the last, we've only had 2 down years in the stock market since 2008. That was 2018, 2022. But since that period, if you overlay the US stock market versus the rest of the world and the dollar, it's the same chart. And they're both starting to show little cracks in that trade. So the key thing to remember is what really drove the dollar and what's really been the kind of drivers, US risk assets outperforming the world. And but the bottom line is, what's the alternative? Gold is the only really major alternative. All other paper currencies are, in a scale 1 to $10, not so great, but it's the 10. Everything else is maybe the euro's a 5. Maybe Swissy's up there, but small country protected by U.S. according to Jamie Dimon of JP Morgan. But the key thing I want to mention when people talk about the dollar also is there's the macro. If it continues lower, it typically means a sign that risk assets, U.S. risk assets are being sold. And that's what I'm hearing. I'm in London this week, and I'm hearing that from some prominent investors who are just lightening up on their U.S. assets. And that's what I'm hearing from U.S. investors are lightening up on risk assets and using alternatives. But the key thing to think about here, the macro looking forward, is there's an overwhelming force, a much greater indication of what's really happening in the dollar, and that's cryptocurrencies. The most significant trend in all this space, it's massive, it's a massive casino, lots of speculation, but the most enduring trend is the proliferation of crypto dollars. Some people call them stablecoins, I like to call them crypto dollars. Right now, about $300 billion. 2018, it was just one. It was Tether. It was $2 billion. It's just a better technology, and the world's adopted this technology organically, going to the dollar. Where an average person in India who can get a phone now for $12 can get access to the buck. They don't need to take risk in Bitcoin. And to me, that's the key thing to remember. What's happening in the dollar. So about the world's about 130 currencies, which used to be many more. It's going to continue to narrow down and all focus on the dollar as the base layer for everything. And the key thing is to watch that through what's happening in stablecoins. This technology allows you to have access to it easily, and the world is going that way.
Yeah, that's a very good point, Mike. And I would also mention the bond market as well. So I've recently done a lot of interviews, and some of the guests believe that the interest rate should be lower. Others believe that they should be even higher. What's your view on this dynamic between interest rates and economy?
Well, I'm glad you went there, because it's also a good part of the market that's so important that we make a good market. It's some people are bullish, some people are bearish, and here's the market that I started in the trading pitch in Chicago, trading Treasury bond futures in 1988. So it's market I thought I knew the best, except the last 2 years I've been dead wrong. It's just been waiting for it to happen, and I think the best next big trade is going to be U.S. Treasury long bonds. Now, the high for 2 weeks ago was 5%. As we speak, it's 4.66. I think they're going to head back to 2% or so, as you see in China, as the world tilts towards deflation. And obviously, that's a minority view, and I like it that way. I have to be, it can't be consensus. If I'm consensus, why bother to talk about it? Because it's consensus. So to me, that's what's happening, and it's a normal cycle. Like I said, so we're seeing that. You look at it, most bond yields in the rest of the world, most are 2 or 3 handles. U.S. is still 4 handles on the front. I think those are going to just drop lower. And the number one force that's holding that's been made me wrong on this wrong. I mean, I haven't lost a lot of money. It's because you're getting that coupon, but I haven't made any yet with those outlooks. And certainly have been in gold, is the number one force that's keeping U.S. bond yields elevated is the U.S. stock market, the highest ever. That's keeping inflation high. It's keeping the Fed away from kind of curtailing the easing. Obviously, they're going to ease after we speak, and they're going to start that easing cycle again. But it's very rare for them to do the stock market elevated. So I think the number one force for U.S. bond yields to tick down towards the rest of the world, most notably China, Japan, Germany, which are all 2 handles or lower, even Switzerland, is so that U.S. stock market just back up a little bit. So to me, that's what I'm looking around. The U.S. bond market is basically a put on the stock market. And if the stocks keep going up, yeah, that's going to curtail Fed easing. It's going to keep inflation sticky. It's going to be bad for bonds. And yes, everybody always points out the deficit spending. I like to point out, well, like I said, deficit to GDP in China is on 300%. Their 10-year note yields around 1.79, and similar in Japan, 200%. I have to give the example of trading JGBs. Started trading those, gosh, Vladimir, it was almost 30 years ago in the 90s, and everybody was, when I was trading them, I was marketing them, I was selling futures and option position. Everybody in the whole planet wanted to be short, thought yields were going to go up, prices were going to go down, and did the opposite. And they're just finally starting to tilt over to go back up. So I think this is what's happening. So we're heading China's turning Japanese towards deflationary forces, and I think all bond yields are going to go down in the deflationary spiral, which is the opposite of consensus. The key thing to remember, a lot of your viewers and listeners will know, it's be careful of recency bias. After you get a period of inflation, which we've just had, some people get stuck in that mode. We're going to get more of it. Typically, that's when you lead to deflation, and that's why I point out PPI in China is running minus 2.9, almost 3% for a reason, because it was up too high and it's going down, and it's getting pressured from the rest of the world, pushing back on them deflating, exporting their deflation.
Yes, bonds are such a contrarian play right now that it almost makes it interesting even for people like me who before would never get interested in bonds. It's very interesting.
Well, let's just point out what's happening recently. It's that right now there's an inflection, there's a demarcation line, and that's 5% U.S. Treasury long bond. You can lock in 5%. I mean, it reminds me of 1990 or so when they were bumping up against 8, 9%. Yeah, it was much higher. It was a much more inflationary period. Now, if you can lock in 5% and you're a retired person in the U.S. Or anywhere, and boomers all retiring, it sure looks a lot better than. You've had some outstanding. You've had in the last 10 years, certainly since 2009, you've had one of the best periods ever for the U.S. stock market, certainly versus the rest of the world. Back then, if you look at the S&P 500 divided by the MSCI U.S. index, it was about 1-to-1. Now it's almost 2.3 to 1. The U.S. has taken off, and so U.S. assets are way overvalued. And it's a question of how long they can stay there, and if they can go higher. And just a little reversion, I think, is what some bond measures are pointing out. But a lot of this is it's not foreign, and a lot of it's domestic. And I think that's what's happening is at some point when we get cracks in the armor of that U.S. stock market, I think there'll be a flood into U.S. treasuries.
Mm-hmm. So I think, Mike, it's time to move to the commodity sector and precious metals. So gold and silver both performed quite well, objectively speaking. And I believe there's still the forces that caused the price to go up are still there. And in my personal opinion, the masses are still not involved. So it's the big players that are buying gold. And I would love to get your opinion on the current valuations and some of the forces that you believe are playing in gold's favor right now.
So in this reminder, I like to point out there's 4 precious metals: gold, silver, platinum, palladium, 4 majors that matter. The rest of them I either can't pronounce or I can't trade. And there's 21 million cryptocurrencies. So supply and demand is going to favor the precious metals, particularly in an environment where the world might be having a little bit more of a reversion in risk assets. And beta in this space is gold, and gold is driving everything. Central banks are buying gold, not really anything else, maybe some silver, and they're buying it at a pace that's almost unprecedented, 2 to 3 times the average of the last 10 years, according to the World Gold Council. That's, the last 3 years have been double, 2 to 3 times what they bought the last 10 years. And there's good reason for that. Russians invasion of Ukraine, and now we have this wonderful U.S. president who's very discombobulated. So gold's on a tear, and also saw what's happening with deflating currencies. So I think what needs to be put in context is you mentioned silver. Now silver on a 1 year basis is up about the same as gold of 40%. That's actually very poor performance for silver. Now, silver's up as we speak. It's $42 an ounce. I think it's a matter of time it gets it to a new high. But the key thing to remember is it's called the devil's metal for a reason. It's leveraged gold. It typically trades 2 times the volatility of gold. So if you're holding silver and you're taking, you have double the risk, by the way. Your daily fluctuations are 2 times what gold typically is in terms of percent, and you're getting the same return. That's poor performance. So it's just catching up. And so gold's still baiting the space. Gold's obviously getting expensive. It's at an all-time high as we speak. As we speak, it's almost 30. It's 3,700 or so US dollars, and that's cash gold. And everything else is catching up. For instance, palladium. In May, not palladium, so palladium was overdone. Platinum was the lowest ever versus gold. We have 35 years of data, and it's just catching up. And obviously, when the other metals get that cheap and they're to beta, they'll catch up. And to me, the key driver is still gold. The key question you ask yourself is what stops the gold rally? Yeah, sure, it's a bull market. Bull markets get overbought. But the key thing I want to point out, Vlad, that I check every day to see these signs of overboughtness. Some markets, the signs that you might have a trigger and hit some sell stops, and it's not showing up in gold. In fact, it's the opposite. The key thing is you start with futures, the most speculative X's. I used to trade them. You have 20 times leverage typically, and hedge funds, managed money, net positions. Are right now about, in terms of the main gold contract that trades on the COMEX exchange, they're about 33% of open interest. Last year's peak was around 47% of open interest. So that market was a lot more overbought with specs being long than it is this year. So not a lot of specs being long there. And then there's ETF inflows, significant inflows this year. We had 4 years of outflows, and this year's completely flipped. Inflows are kicking in. They're up 12, 13% this year. You see it high every day, but they're still well below where they peaked at about 110 million ounces in 2020, 21. So there's a lot of room for that to make a new high. And also, if you look at since 2008, ETFs were leading the flows. The percentage change in the flows were leading the gold market. Now they're somewhat lagging. So gold's being driven by a key factor other than more Western type investors, and that's central banks. And we don't really know exactly how much China is buying, but just by the indications I see, by that showing up in speculative excesses, there's only one other major force that would be driving gold that much, and that's the underlying accumulators from most notably sovereigns.
Yes, and Mike, would you care about gold to silver ratio at all?
Sure. Oh, absolutely. When it reached 100 early in the year, I wrote all about it. That's not a good sign for gold to silver. First of all, you know the history of gold to silver. I think Sir Isaac Newton, when he was in the UK, when he was head of the mint, I think initially pegged it around 16 to 1 as far as what was known reserves of silver. But it's also been a great economic indicator. And the key thing is you can measure gold versus like crude oil, completely different commodities, and it's really a bad sign when crude oil's going down, gold's going up. But versus its brethren in precious metals, reaching 100 was a pretty good resistance. Right now we're at 86.5, still pretty elevated, but that's a global deflationary trajectory. When silver is really much more of an industrial metal now, much more in the past. So when you look at the gold silver ratio, you have to factor in that gold is money and the store value, and it's demonetized silver. And silver is much more, you buy it less now for jewelry, and it's much more industrial. But it's just a sign. It's like comparing gold to any of the other industrial metals, maybe copper, platinum, and palladium. And just these ratios are showing what you'd expect in the whole world facing the unprecedented tariffs from the US after, kind of getting addicted to them for the last 50 years. And I'm afraid it's a leading indicator of what we might get as a bit of a global recession. So I'm not bearish silver, but I'm still bullish gold. And I'm just pointing out is we have to kind of get that inflection point. What it points out to me is the thing I'm worried about is I'm looking for signals when it's maybe time to overweight silver. And yeah, at 100 to 1 gold, sure, that's the time to overweight silver. But remember, you're still trading double the volatility and getting the same returns as gold at these levels.
Mm-hmm. And Mike, would I be correct to say that gold as a percentage of portfolios globally is still quite on the low side?
Minuscule. Well, I just remember years ago it was less than 1%, and I just haven't looked. I can probably chat GPT it, and but it's minuscule. And why? Because the key theme I've used for years is why buy gold? when stock market's on a tear and you can get 5% in U.S. Treasury. Now, okay, stock market's still on a tear and you get 4% in U.S. Treasury. And despite that, there's been significant inflows in U.S. ETFs and overall global ETFs. So to me, I think what's happening is prudent investors are starting to figure out, okay, I got major profits in all my equities. It's time to skim those profits and buy in the store value, but there's still a small portion of portfolios. And the key thing to remember, everything is a small portion of total U.S. stock market cap now because the stock market cap's so high. As we speak, it's about $70 trillion. It's the highest ever. It's 2.3 times GDP. And put that in context, that's almost double the U.S. Deficit, which is close to, 37 trillion or so. It just puts the U.S. deficit in context. When people say it's really high, I'm like, yeah, it's high versus U.S. GDP, but not versus the stock market cap, which puts the stock market cap into, that's the sore thumb on a global basis for all markets. Is we got to sustain those levels. Trump administration gets it, Bassett gets it, Fed is kind of worried about it, and the whole rest of the world, I think, understands that, yeah, probably going to get some normalization. Should be careful.
Mm-hmm. And Mike, do you see opportunities in miners right now?
Oh, sure. Well, they're up a lot this year. The key thing is, remember about miners, they're up a lot because they were so underperformed a physical market for so long. You take the GDX ETF divided by GLD, the other ETF, the physical gold, GDX is just going down forever. And it's caught up this year. And it makes sense. I mean, you still tremendous earnings in that space. Some of my clients and people I know who've been overweight these for long are really getting back some of the, what they didn't do well for the last few years as the price of gold took off. But yeah, the key thing I'm worried about, Vlado, is that if we get that normal correction beta, the equities will have a pressure factor, but we're not getting that yet. So I'm still biased towards the physical market, but the equities, you get earnings over time. You should and you get the optionality. You get those earnings and optionality over time. And just right now, they were just so cheap a year ago versus the underlying physical. It's just nice to see a little catch up there.
Yes, and from the business perspective, I think some of the good companies are doing really well from the free cash flow point. They're very, very healthy at the current level.
Exactly. Yeah, I hear them. So, but it's great. Should continue.
Sure. And I would also like to mention some of the other commodities like copper, uranium. What would your thoughts be on those?
Yeah, not too much. I don't do much in uranium because it's not traded actively in futures markets and indices. Maybe I should. Eric Townsend is one of my favorite persons on Macro Voices. I trust his views on uranium. But copper, the number one commodity that I'm really worried about, has to go up, and it's put in signals this year very similar to what crude oil did in 2008, right about the same time of year. Crude oil peaked in July 2008 around 147, and by the end of the year it was trading 40. Copper's done the same thing. It started around 4, it's bumped up to 5, 30 or so, back to 4, almost to 6, and for good reasons, trade issues, and now back to 4. And here we are as we speak, we're about 470. To put copper in context, I'm using the U.S. price copper because the center of the world right now is U.S. copper. Sometimes it's London-based copper, which is around $10,000 a ton, but right now it's U.S. copper, and partly because what's happened in the tariffs and what the market's done this year. So I'm looking for it for signals, and to me, the risks are that it goes down, meaning let's put it this way. On a annual basis, the highest ever close for copper at the end of the year was 446. And that was 2010 and 2021. And here we are right now, 470. So if we close here, copper is looking at the whole world and, that economic census model and saying, yeah, despite this major pressure from U.S. tariffs and the shift in the world order and China kind of going into economic decline in the rest of the world, facing economic decline, as certainly in Germany and some of the European states, copper's doing fine. So I'm worried that by the end of the year, it's going to break down below support and get below 4. So key thing also, and if it can close there, that'd be a great economic signal. And so one thing I'm also key catalyst for copper to go down, Vlad, is guess what? U.S. stock market. I mean, if that goes down, I think copper collapses. So to me, it's the same trade right now, and everything can be the same trade when you get this high in U.S. stock market. But the one thing I want to really point out about copper is it's the risk versus reward of it going down, and it's the kind of the things I hear and see, and having been an ex-trader, an ex-investor, and now I just say it, is it looks to me very much like Bitcoin. It's reached a major threshold this year. Every technical indicator, every technical analyst says it's going up and should continue to go up, which means everybody's on board and the risk start goes down. So I look at the optionality as a form of an option trader. The optionality in copper is it goes down and tilts and shows you that bent towards what's happening in crude oil. It's rare for copper to go up and crude oil to go down. It's rare for copper to go up and iron ore to go down, which is going down, and for bond yields in China to go down. And if U.S. bond yields start going down with the stock market, copper could be, it's to me, it's right at the tip of the iceberg of potentially breaking down. But for so far, so good. It's up on the year, copper, U.S. traded copper is up 17%. It was up 35, almost 40% for a year for a while. Remember, and it's only September, it's early. Q4 should be really important for copper.
Yes, some really good points, Mike. Thanks for that. I would like to ask you about some of the things that you would be thinking about when structuring a portfolio in the current environment with all the risks that we have.
Yeah, well, the bottom line is I don't really give investment advice, but there's certain times to be overweight risk-off assets like gold and treasuries, and that was my bias at the beginning of the year, and I stick with it. I don't have any reason to change it. One of my key signals was Bitcoin reaching 100,000. To me, it was a major threshold. Massive speculative excesses, and the classic sign you're supposed to be selling when they're yelling. Well, they're certainly yelling in cryptos. That's a sign you're supposed to probably be lightening up. And just the fact that gold's outperforming virtually every major risk asset on the planet, most notably on a risk-adjusted basis. Remember, gold is a third the volatility of Bitcoin, and it's about the same volatility of S&P 500. It's much lower volatility than most other risk assets, and yet it's outperforming. That's not a good sign. So as we tilt towards the end of the year into fourth quarter, I'm afraid it's going to be similar to fourth quarter 2008. I hope not, but that's why I'm saying there's certain times to be overweight risk-off assets like gold and treasuries, and I still stick with that view, which I had at the end of last year.
Yes, that makes total sense. And so, Mike, I like to ask this question for the younger audience. If we have an individual who's still at the beginning of his and her wealth building path, they have so many options now with the cryptos, with NVIDIAs, with the things that we're discussing. What advice would you have for that individual so that they don't make too many mistakes at the start and don't get burned too much?
So first, I'll give the advice that I find annoying, but it's standard: diversify. And at a young age, you're supposed to be overweight risk assets and not trade. If you're trading cryptos, good luck. It's okay to trade. It's fun. I'm trading from the trading pits, futures trading pits. It's usually leverage 20 to 1. But don't underestimate what cryptos are. Number one, I would say be very careful. Buying into that mantra that you're supposed to just be what they call stacking sats in terms of very volatile risk assets that went up a lot. So then one lesson I'd say right now is I stick with the view that I think there's certain times to not be worried about being overweight risk assets. There's certain times to be underweight risk assets. Cryptos are the riskiest. And the way I like to point out, in 2009, there was one, Bitcoin. It's revolutionary. It's had a great run. Now there's 21 million. So the lessons of unlimited supply are typically not good for price, and there's only 4 precious metals. So I'm overweight and biased. My bias is I think the next big trade might be gold, still doing well, but passing some of that performance baton to treasury bonds. And the bottom line is there's just certain times not to be worried about trying to never chase a bull market. And when you're young, you buy and hold and dollar cost average in, and I just look at. So here's my outlook. I'll point out that in 2018, when Bitcoin was dropping, it was around 10,000. I said it's likely to drop to zero. It got close. It went to 3,000. Okay, so I got 70% of that trade. You can say it was wrong, but got most of it. I still think it could easily drop to zero. The whole crypto space could easily drop to zero. And one example I gave you is unlimited supply. And I'll give you this example: one cryptocurrency, number 8 on all the cryptocurrencies is Dogecoin. It's a joke. It's worth $40 billion. That can easily drop to zero in valuation and still be overvalued. So I think the whole place is looking for a purge. And I think what's going to happen is a lot of young people who the joke is if you ask someone under 30 about gold, they don't really care. They call them boomerangs. Because they like cryptos, but they've had a great run. I think we're towards the end of that run.
Mm-hmm. Yes, I'm under 30, Mike, but I certainly like the precious metals.
You're smart and diversified, and that's a good idea. But it's also a key thing that I love this because I look at my joke is I like to say 60 is the new 40. I would say just turned 60. Think of yourself when you're 60. What would you say to yourself when you're 30 or 20? And I do that to myself now when I have, I enjoy getting the questions. And I remember when I was 30 and asking the 60-year-olds how to trade and things. And it's good to listen and then obviously use your own views, but think about how you might change. If anything, the best thing is to study history and study the history of markets that get too expensive and too cheap. The key thing that's happening right now is on a global basis, the US is just too expensive. Now it's getting more expensive. It's a question how long. And what's really cheap? It's China. And it's been that way. And guess who's buying China? Their own government, just like the Japanese have been buying ETFs for 10 years or so. They're buying their own. I'm just pointing out facts of what's happening and more valuations. And also I look at things like, here's a good examples. Look at Tesla. There's a great book called The Price of Tomorrow by Jeff Booth, just pointing how technology is moving so fast. You can't keep up with it. It's a very deflationary force. Obviously, he's very bullish Bitcoin, but it's a key thing that I think to think about for young people is read that book or read The Price of Time too by Edgar Chancellor. That points out the whole history of deflation following inflation. And this is a great time to say, as you know, may you live in interesting times, but be very careful, worried about chasing bull markets, which I think is happening right now. And we're due for some normalization. We're due for a bit of deflation. We're due for a period of unemployment, unfortunately.
Mm-hmm. So, Mike, these are all the questions I had. Is there anything else that maybe we haven't mentioned that you believe that's important?
No, I think I'd tell you. I'll probably remember after we speak. But to me, the main thing is the macro. What I mentioned there is this. And the key thing I think is so we're almost end the near end of Q3 in the U.S. and the VIX volatility index in August reached its low for the year around 14%. It's been going up on a 200-day basis since Mr. Trump was elected. I think it's going to still continue to go up. And the bottom line, I'll give you two key outlooks I have is we've had two 50% drawdowns in the U.S. stock market since the beginning of 2000. I think we're due for another one. When I say that, some people look at me like that's crazy, but it's not profound. We've already had two, maybe not another one. So it's a key thing to keep in mind. The key indicator I have for that is what gold is doing. I'm really concerned about what gold is telling you. And then what cryptocurrencies are doing. They're just, when they tell you they can't go up or can't go down, nothing but up, then you have to worry about going down.
Mm-hmm. So, Mike, I really enjoyed the conversation. Thank you very much for your time, and I hope to have you back, sir.
Vladyslav, I'm looking forward to coming back.